Hi everyone. So we're doing some tests today, trying a new format. So I'm doing this video to try and explain financial concepts easily to both interested investors that have academic knowledge of finance, and also, and most of all, people who don't necessarily know these concepts. So today we're looking at volatility, which is one of the biggest concepts in finance. Volatility is used to compare stocks, either compare one stock at a given time compared with another time frame. So maybe we're looking at Apple today and this year, looking back 10 years and comparing with 10 years ago. Or it can help compare stocks one against another. So maybe we're looking at Apple and comparing with Meta over a given time frame. So by definition, volatility is a measure of how much an investment's price goes up or down over time. So volatility is a measure of risk, and that's why it's interesting to investors. Because when you invest in something, you want to know how risky it is, and volatility as a measure of how much a stock goes up or down is a measure of risk. So for example, you can look at this stock in red is less volatile than this stock in black, but we'll look at some graphs further in the video. So volatility is based on a mathematical formula. We don't need to go into the formula itself, but I just wrote it down so that you can have a look at it if you have mathematical knowledge. If you don't, no worries, you can still understand the concept. So it's called standard deviation, and standard means the average deviation, and the deviation is the deviation from returns for a stock against normal or average returns. So here we're looking at a square root, doesn't matter, of this is a sum. So a sum of Ri minus R. Ri are the actual given returns. Every point here is compared to the average returns. So if this trend line is the average return, we're looking at every number compared to this average return. And this divided by the number of returns we're looking at gives us the standard deviation. And volatility is basically another name given to standard deviation. So it's a measure of how much returns deviate. This is very important to understand, from their own average, not from the market, but from their own average. Sorry, just making sure everything is in frame. And this can help normalize data, because we're looking at a stock compared to itself and not to something else. And when you compare something to itself, you tend to normalize the data, and it gives you not a ratio, but a mathematical value, standard deviation, that is normalized. And you can compare two stocks that have very different prices against one another with this mathematical and statistical knowledge. So for example, I don't know the price right now for Berkshire Hathaway, Warren Buffett's stock, but it's around like 400,000 USD, and you can compare it to a stock that is $200 per share, because it is normalized. Key points for volatility: it's a risk indicator. Volatility shows how predictable returns are. So we give a prediction, the average return, and we look at how far up or down it is compared to the prediction. It is measured by standard deviation. We just saw that. It tracks the spread of returns up or down around the average. And it helps in investment decisions, because you might want to do a relatively conservative portfolio with low volatility, or you might want to invest in very highly volatile stocks or cryptocurrencies, for example, because, for example, if you're young, you want something more risky because you don't care if it goes down next year. You're trying to build up your retirement fund. Volatility is paired with higher returns and or losses. So volatility is basically you don't know how much the stock market will return next year, but you can know in advance if it will be a big loss or a big upward movement based on the volatility of the stock market or the stock you're looking at. Then it also changes over time and periods. So you can compare a stock against another stock, but you can also compare a stock to itself on another time frame. And then some examples. So here I've got two graphs. We can call the green line stock A and the red one stock B. So here we're looking at the price of the stocks and how it evolves during a time frame. And here we're looking at volatility. So with these two graphs, you can see the relation between volatility and price of stocks in the same time frame. So here stock A is pretty conservative. You can see the price has a barely like downward trend, and the red one also pretty straightforward trend. So the trend for the two stocks is practically the same. It begins around the same spot and ends around the same spot, and also you can see there are the same trends. Here the red one and the green one go upward at the same time. Here the same, here same, but the red one is much more prone to moving like in big directions compared with the green one. And this translates to a higher volatility. And volatility here, it's always above zero because it's a square root, as you can see here. We don't need to look at mathematical data, but still. And you can see the red volatility. Let's say the average volatility for the red is here and the green is here. You can see the red one has a much higher average volatility than the green one. So basically using volatility, you can understand that stock A is less risky and stock B is much more risky. And this can help build a portfolio or stock pick or something. So in conclusion, volatility is one of the most important statistics around the security, and it can help compare stocks against one another or even a single stock over its own lifetime. So yeah, that's it.